Hello and welcome to this week's Australian Share Market Report. I'm Dale Gillum, Chief Analyst at Wealth Within. Now this week I'm going to be discussing timing the market, the All Ordinaries Index and some interesting stocks on the market right now. Before we jump into the report, I'd just like to mention if you have any thoughts on investing or trading, please comment below and subscribe to our channel to keep up to date with our new content. So let's get into the report. Contrary to what some may think, when it comes to investing, timing is critical for your long-term success. Getting into the right stock at the right time can dramatically improve your portfolio returns. Now, there's a common misbelief pushed by the big end of town that time in the market is how you make money when investing. But all successful traders know that statement is very wrong. It's not the amount of time you hold stocks in the market, it's timing your entry into and out of the market. Let me explain. Have you ever heard the saying, quality over quantity? Well, it's a similar principle that applies here. Let me ask you how you feel if you're holding a stock that's declining in value. Logic dictates that you probably wouldn't be too happy. However, if your stock is rising in value with no indication of a change, would you buy it? Again, logic dictates you probably would. Making money in the market is quite simple. Never hold stocks that are falling and hold assets that are rising. A big issue I find is that all too often people buy a stock because they perceive it as cheap. But let me ask you, what is cheap? If a company is trading at $10 and has a value of $20, then it's cheap. If another company is worth 10 cents per share but is valued at 5 cents per share, then it's expensive. The price of the share on its own does not determine whether it's cheap or expensive. It's only one part of the equation. Trading is about timing the market and picking stocks that are actually cheap and starting to go up in value, and getting out of stocks that are becoming expensive and starting to fall away in value. Timing the market also helps you manage your risk. In fact, timing allows you to have lower risk than a buy and hold strategy. Good traders can identify with high accuracy when a market is at its lowest risk and therefore the best time to buy a particular stock. They can also determine when a stock or market is at its highest risk and when it's likely to fall, and so they can determine the best time to sell. Being able to recognize and time the market greatly assists you in picking your entry and exit points while achieving greater profits and reducing losses, all of which every investor and trader aspires to. Now, a golden rule is to trade on confirmation rather than speculation, and being able to time your entry and exit is exactly that. And believe me, it really makes a world of difference to your portfolio's performance. At Wealth Within, we practice what we preach. Now, we have a direct equity managed account service where we manage individual portfolios for our clients. When we do this, we time entry into and out of stocks. Now, depending on market conditions, it can take up to 6 months for us to fill portfolios, as we just don't buy stocks just to get things over and done with. To ensure we make money, we want to enter into positions that have higher probability of rising in price. In essence, we wait for good opportunities rather than hope for them, like the majority of those in the marketplace. In my book, Accelerate Your Wealth, I show how timing the market is a vital tool for investors and traders, and those who practice it will always have portfolio profits and greater success over the medium to long term than those who buy and hold. So let's get into the charts. Okay, looking at your screen right now, I've got the All Ordinaries Index. I got the weekly chart on the All Ordinaries Index, and as you can see, if I expand this up a little bit, you can see that the All Ordinaries Index here had a huge run last week, which is a bit what I was expecting. As I was saying a few weeks ago, I thought the retracement down into this low in June here, or early this month, it was going to be very short before we start to move up and break through that high of 6245. It did that in streets last week. As you can see, the range is 152.2 points, so it's a massive rise quite quickly. Probably a little bit quicker than I thought. Generally when things move quite quickly, they'll slow down a little bit, and we saw that in this previous week over here, back on the week ending the 4th of May, how we had little move, little move, little move, and then a big move, and then it petered out a little bit. So what I'm expecting here is I've just put some price targets on here of where I think the All Ordinaries Index will go to. Now, I did mention I thought a few weeks back I thought the market would move up to 64 to 6,600 points, and what you're roughly seeing on your screen is why I was talking about that. So at this point in time, that next level there that I'm looking at is 64.04 and then 65.81. I probably think it's going to get up to 65.81, but I don't think it's going to go straight up to there. I think we will have a bit of a retracement prior to it doing that. So we may see another 1 or 2 more weeks up here, possibly 3, but probably more likely 1 or 2. Then we'll see a movement down a little bit, and then it'll break through and move straight up into that around that 6,600 points level there. I'm also going to put another different projection on, and you can see a different set of figures now on your screen here. And looking at that, you can see here around here that 64.84 and 65.87. That's what I'm thinking here. That 65.81 is probably going to bring a halt to the current move up before we get a slightly more significant move down. Currently, we're in week 1, 2, 3, 4, 5, 6. Oh, sorry, did I count that right? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. I think we'll probably be making it a peak at around about 18 weeks. There, so about another 6 or 7 weeks we'll probably make a peak up around to that 6,600 points. Just want to quickly look at the Aussie US dollar. I know we did chat about it briefly last week. We chatted at about here the 18th of June, which was Monday the 18th of June. And I said it was probably going to keep falling to around that 73 odd cents. It has done that. It made a low on the 21st of June at 73.45 cents. Now, it remains to be seen whether this is going to hold it up. We did have a strong day on the Friday, or last Friday on the 22nd of June. It did hit a low of 73 cents and a high of 74.45 cents. What I need to see now for if the Aussie dollar is going to start moving up is to see a couple more days up and then a couple of 1 or 2 days down and then move up again and make sure to prove that low there at 73.45 cents is the low at this point in time. It's a bit too early to tell if the Aussie dollar is going to move back up above that 74 up into 75 and 76 cents at the moment. I'm still assuming it's bearish. If we're looking at stocks, I wanted to go and look at telco stocks today because it's, you know, we do get, I've been getting people giving me emails and asking questions about Telstra, and as you can see, Telstra's on your screen, and I've always named this the dog stock of the All Ordinaries Index, of the big top 20 anyway, because it just seems to constantly go down. Now, if we look at Telstra, you can see here it has a long history, dating back to 1996, and most of the time, if you just look at, there's only 2 major runs up from when it first floated to its all-time high in February 1999, and obviously from its low in around 2010 that you can see there on the chart up to its high back in 2015. The rest of the time it just falls away. But it's a good stock. It will rise. It does make money, and so therefore it's going to stop falling. Now my bet is, and last time I looked at this, I said that $2.55 low in November probably will be the low, and I said it wouldn't surprise me if we double bottom, or this stock double bottoms at that point. I thought it may have been starting to rise a few weeks back through into here. If I just zoom it up a little bit again, I thought it may have started to move up again on last month. But it didn't. So at this point in time, it is looking bearish. We've hit a low of 264. We're only 9 cents off that all-time low. If it does find some support there and starts to move up, I think I'd start to get excited about Telstra. But please do not jump into this stock too early. It's like catching a falling knife. A lot of people hold it because of the dividend yield, and that's never a good reason to hold any stock just because of a dividend yield. If you're losing 20, 30, 40% on the capital, then just getting a 3, 4, 5% dividend yield is not smart investing. Let's look at a couple of the other different telco stocks. This is TPG. It's done very, very well, TPG, over the years. Moved through to a high, as you can see, in July 2016. It did a lot of takeovers. You know, we're talking about, it owns IINet. TPG also owns AAT, and so they're big in the telco sector, the internet providing internet, all sorts of different corporate services as well. They still keep those brands separately, but if you subscribe, I know we subscribe to some of their services with INET and AAT, and obviously also TPG. So they are big. Right now, looking at this weekly chart, if I bring it up, You can see here they are looking a little bit more bearish and moving down. So be interesting to see if it holds above that $4.86 low in September 2017. At this point in time, I'd still think this stock is bearish, and it's likely to be more bearish until it stops falling away. So I wouldn't be getting into it, but it'll be on my watch list. What I want to put on is Kogan, just because it's interesting. It's more of a retailer than a telco. It did backdoor list on the All Ordinaries Index way back in a couple of years ago, back in 2016. So to me, the data prior to this that you see on that left-hand side of the screen is pretty much irrelevant for this stock. But looking at it more recently, Kogan did take off like a rocket from when it back in 2017 all the way up to that all-time high there in March of this year at $10. It's got a little bit of weakness at the moment. I think it's going to continue to fall away. Generally, when things go really vertically, they do start to fall away. They do need to retrace and come back to their normal rhythm. I think that's all this stock is doing. I think it's got further to fall. I think Kogan is probably going to, if I just put my little tool down on here, you're probably looking at somewhere around that $5.60 mark. It'll probably pull that up at this point in time. 560, 570 in that sort of bracket. So if you do own Kogan, I think there's some more downside on it. I wouldn't be buying it at the moment here. One other one I wanted to sort of have a bit of a look at, if I go through, and there's my little tool here. I just want to have a quick look at Vocus. Vocus is it's a smaller company, but it's looking quite interesting at the moment. Now, Vocus, from memory, does own some of the Telstra stores, the Telstra business stores. And come on, you can expand out for me. But you can see here, down over there on the weekly chart, which I've just expanded up now, it has fallen quite heavily from sort of $9.40 way back here in June 2016 to this more recent low at, $2.11. But it's risen up to that high here of $2.74 on the 18th of May. Now we're a month on from that, or just over a month on from that, and it looks like it's finding a bit of support around here. If it starts to move up from here over the next few weeks and breaks through that high 274 from the 18th of May, then I think that might be a nice little, I wouldn't say speculative buy, but you know what I mean, one of those little dark horses that could do quite well for you. So that's it for me for the charts for this week. Good luck, good trading, and I'll talk to you next week. What are your thoughts? If you've got any questions, please comment below. Go and listen to our Talking Wealth podcast. They're available on Soundcloud and on our website. Now they're jam-packed with valuable information which will help you elevate your trading. Now if you're serious about learning to trade the share market and you'd like more information about our courses, please click the link in the video description below. Thank you very much for watching this video. If you've liked the video, remember to subscribe to keep up to date. I'm Dale Gillam, the Chief Analyst here at Wealth Within. Goodbye, good luck and good trading.